and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, you know what one of the weirdest things about 2023 was? I mean, I guess that's an unfair question, isn't it?
Why don't you just tell me what's on your mind? And, you know, I could make many guesses, but why don't you just tell me?
So after all the drama in the bond market, all the ups and downs, all the volatility, we basically ended the year kind of where we started, right around 3.8% on the 10-year yield. And I know it's picked up a little bit since then, but we basically had this really round trip, but a lot happened in between.
That was a great choice, Tracy, for one of the weird things that happened. Yes, that was a huge story throughout the year, bond sell-off, higher rates, etc. And then to get to the end of December and say, oh yeah, the 10-year is basically where it started the year, extremely strange and unexpected. And when I saw that stat, I was like, oh, I did not anticipate that at all.
Yeah, and to me, maybe this is going to be a bit of a tortured analogy, but 2023 is sort of emblematic of the bond market overall. People tend to look at it and think it's super boring. Normally, you know, before the wild years of 2021, 2022, 2023, it didn't move around that much. Bonds were supposed to be boring in that sense. And I think people have this view of like, okay, you buy a 10-year or maybe you buy a tip or something like that. You invest in T-bills to get a little bit of pickup, or maybe you sell some bonds. And that's basically the extent of investing in the bond market. But there's this whole world when it comes to trading fixed income and interest rates that gets really interesting, really complicated in some ways. And I feel like we don't talk about it enough. Like every once in a while it hits the headlines, like, when Bill Gross was talking about selling volatility before he left Pimco, everyone was like, oh, wait a second, there's a big bond investor selling volatility. I wonder how they're actually doing that.
Yeah.
But more often than not, we talk about yields, we kind of connect them to what's going on in the macro economy and inflation and maybe the US debt, and that's it.
No, you're totally right. I mean, there's really two things. I mean, part of the story for bonds over the last 2 years was the end of this incredible 40-year bond bull market or treasury bull market. And there were a few interruptions, of course, in 94, et cetera, and we know about that. But by and large, bonds went up, yields went down, and bonds were like a nice hedge against your equity portfolio, and 60-40 type portfolios were great. But then the other thing is, you say, if you talk to an equity manager, they'll be like, oh, I like tech stocks. This year I like energy. They'll just some rotation. We like big caps, we like small caps, we like international, but it's like different flavors of being long. Whereas, when you look at how a lot of fixed income portfolio managers invest, as you say, it is often various flavors of derivatives around fixed income or, spreads and things like that, rather than just sort of long here, long there.
Exactly. So I am very pleased to say that today we do, in fact, have the perfect guest to talk about the intricacies of fixed income. We have someone who actually used to work at Pimco. He's now managing partner at Simplify Asset Management, perhaps better known as the Convexity Maven. So we're going to be speaking to Harley Bassman. Harley, thank you so much for coming on the show.
Thank you. Good morning.
Very excited to have you here. I should have added to your intro that you are also a master of colors, right?
Which we're going to get into. The best color line charts in the business.
Thank you.
So I have a question to begin with, and this is completely out of self-interest. As a journalist who's had to write about convexity at many times during their career and has always struggled to define it in a way that satisfies my editors who want to encapsulate a financial relationship in as few words as possible, how would you describe it?
Convexity, it's an X word, so everyone gets a little rattled about that, but it's actually rather simple. It's just unbalanced leverage, which was also a hard concept. Let's simplify it a little bit. If you have a bet you're making, a wager, where you make $1 or lose $1 for equal up and down, opposite payoffs, that's zero convexity. If you make $2 and lose $1, that's positive convexity. If you could lose 3 and make 2, negative convexity. The reason why we hired all these, PhD, quants in the 90s was to basically figure out what that's worth. Clearly, you'd rather own something that makes 2 and loses 1 than is 1-to-1. And if it's lose 3, make 2, you better get paid for that. And so all the mumbo jumbo we go do around pricing out these various paths and payoffs is just to make it a fair bet when you have these different payoff profiles. And that's it. Convexity just means that the payoff is not linear. It's not one-to-one.
Every once in a while, you get to do something really great on this podcast, Joe, and asking the Convexity Maven to define convexity is one of those things.
This was a historic moment. We're going to clip that. But let's go further down that. So often you hear about, like the most common time you hear about the phenomenon of convexity in the fixed income world is often related to mortgage-related securities. Can you then, can you take it a step further and sort of give us, what does it mean? So you describe the search for positive, naturally occurring positive leverage in the world. Give us sort of a concrete example. Why does this pop up when we talk about mortgages frequently?
Well, you're probably backing into the idea of are mortgages a good value right now or not. Let's just go one step back.
Yeah.
When you're in the bond market, not equities, the bond market, you have 3 buttons you could push. That's it.
Okay.
Duration, credit, convexity. Those are your 3 risks. You start with cash, overnight cash, and anything you do past there is taking one of those 3. Duration is when you get your money back. Credit is if you get it back. Convexity is how you get it back. And what a bond manager is trying to do is move around those 3 buttons to find the best risk return, the best value. Presently, selling convexity in the bond market is the best thing to do out there right now. What's duration? It is when you get your money back. So a 2-year security will move 1.8 points for a 1-point move. So if rates go from 4 to 5, a 2-year bond will move by 1.8 points, a 10-year by about 8 points, a 30-year by maybe 17 points. You're usually paid more to take longer maturity risk because there's more uncertainty. An inverted curve is kind of upside down land because you're getting paid less to take more risk. We could talk why that is in a little bit, but right now duration is a very weird place to take risk right now because you're paid less to go out the curve and buy a 10-year versus a 2-year versus overnight cash. Credit. Right now, investment grade credit is trading about 57 basis points, so a little over half point over the yield curve. And you get that from looking at these interest rate derivatives. On your Bloomberg, it's going to be CDX 5-year. That's actually tighter, smaller number than its historic average of about 65, 66. You're paid 57 now. Junk bonds, you're paid about 360, 350, 370, which is also much tighter than its usual 440, 450, 460. So going into credit now, that's not a great bet. I mean, I wouldn't say it's a disaster, but I mean, considering we're concerned about the possibility of over-tightening, a possibility of recession, which a inverted curve kind of signals, I don't really want to go and take credit risk. Convexity, right now the MOVE index, which is a measure of the price of convexity, the same way.
Which you invented, right?
I did. It's the VIX of bonds, plain and simple, the VIX of bonds. Its average is maybe 90 or 100. It's trading 120 now, which averages out to about maybe 7-8 basis points a day of market movement. That's higher, much higher than its historical average. That's the kind of trade you want to go and do. And a mortgage security is simply a glorified buy right. That's it.
Wait, can I ask, at a moment like this, when, as you point out, there does seem to be a lot of uncertainty, some people are still saying that there's a lot left to do when it comes to stamping out inflation, but the market is already pricing in rate cuts, and some people are still worried about a recession. Is the important thing to choose which of those risks you want to take on, duration, credit, or convexity, or is the important thing to do to identify the exact right expression of the trade?
Well, clearly, if you know where rates are going to go, you just go and buy futures contracts and call it a day. I assume that we don't know where the market will be, usually. And therefore, when you're building a portfolio, what you want to do is you're always going to have some exposure to all 3 of those. What you're trying to do is over or underweight these various sectors depending upon your market view. So right now, what I'd be doing is overweighting the convexity, underweighting the credit, and then duration, I'd be pulling into the 5-year or earlier on the curve for a variety of reasons.
explain this further when you say, okay, you want to be going long convexity, or that's where the opportunity is. Because as you say, the move index, your creation is higher than normal, unlike, say, you're not getting paid for credit. How do you express that trade of going long convexity, and what does that look like?
Well, actually, we're going short convexity here.
Short convexity. Yeah. Sorry. Yeah.
In general, I tend to be a long convexity person, and I like the idea of making two, losing one. So I've done most of my career owning convexity, owning optionality. However, as they say, no bad bonds, just bad prices. There is a level where I will sell it, and we're at that level right now. Before the Fed came in and really scrambled things up in the last decade, the old rule was on the move, you buy 80, you sell 120. The problem with that is nobody would do it. Why is that? When the move got down to, 70, 80, that means the market's not moving that much. And therefore, who wants to go and buy optionality? Who wants to pay time decay when the market's not moving? No one does. So no one buys it when it's low. And when it's at 120 or higher, no one sells. You have some crazy event going on. People are hiding under their desks crying for mommy. So no one sells it at 120. But the reality is you're supposed to go and, not go naked short optionality, but you can go and just bias what you do to make yourself either short convexity or maybe just a little less long convexity in your portfolio.
Just so that we can, when you say, okay, short convexity, what is the type of instrument that allows any trader or investor to express that idea?
The most simple strategy would be for an investor who owns a stock portfolio to go and sell covered calls. I mean, that's you're selling options, you're selling convexity. When you go and you sell covered calls, what are you really doing? You're kind of converting potential capital gains to current income. You're limiting your upside. Your downside, of course, is still large because the stock can go down a lot. But you're basically kind of doing a conversion there of taking risk off the table for current income. And there's a price where you want to go and do that. And there's prices where you don't. When the VIX is at 40 or 50, you probably want to sell covered calls. Of course, you won't do it because you'll be in a panic, but that's kind of the idea. And theoretically, portfolio managers are supposed to have no blood in their veins, and they can go and do these various trades when the time is right.
This is why I'm not a portfolio manager, Joe, because I, in fact, have blood. But actually, this brings me to a question I always wanted to ask, because a lot of your trade ideas, I think they're publicly available. So every year you publish Stocking Stuffers, which is kind of a series of trade ideas. And I'm never quite certain who those trade ideas are aimed at. And the reason I say that is because you will say stuff in them and if you don't have an ISDA credit agreement, here's a way to get around that. But then the trade itself is still quite complicated. So I assume it's not aimed at your average retail investor. Who is the target audience for some of these things?
Well, I'll say that as my career's gone by, I used to target high-end institutions and hedge funds. I've now moved more towards, I would call it reasonably intellectually sophisticated high net worth retail. Is it geared towards the average person? Probably not. But you can still take these ideas and take the flavor of them. You don't have to do the exact idea. You can just do the flavor. So if it's a duration concept, you can take your portfolio from a 10-year area to a 5-year area. If it's a credit area, you could move into single A from double A, things like that. But yes, you're right. A lot of my ideas are a little tricky and entertaining, hopefully also. But yeah, it can be a challenge.
They are always entertaining. That is definitely true. But if you say something like short convexity, for a simplified trade, I would think do something with the MBS index. But that's not what you're advocating at all.
Not right now. Well, my new job, I'm with, I hate to give a plug over here, but I'm at Simplify Asset Management. And what we are doing is we're taking a lot of the ideas that I've had and putting them into ETFs. There was a SEC rule change a few years ago that allowed people to put derivatives, futures, options, all these various things into ETFs. And what we've been doing is putting these derivatives into ETFs, which you could basically point and click on Robinhood. So for instance, 2.5 years ago, I created an ETF where I put a 7-year put option on the 30-year Treasury, more or less, into an ETF. And this was actually, I think, Bloomberg ranked as one of the highest return trades for a while. I mean,
Is this the PFIX ETF?
Yep, it was up 200% for a while. And it's basically a straight up, way to make money if rates go up. That was it. And it was a way for civilians to get to institutional products. And I have a new product out there where it allows civilians to go and buy mortgage bonds. Mortgage bonds it's the second biggest asset class of bonds after treasuries, and it's almost impossible to buy them for ordinary people for a variety of reasons. And what we've done is we have institutional quality trading abilities that we could put into ETFs. We're enabling civilian investors to buy mortgage bonds that are trading, near par. And right now, these par mortgage bonds trading near 98, 99, 100, are what I view to be the best fixed income investment on the planet. Right now, they're trading about 1.5 points over treasuries.
Sorry, what instruments are the best fixed income investment on the planet?
Near par, so right now, 5.5% mortgage bonds.
Okay. And how come? Sorry, you were about to explain it. Why are they the best investment right now?
Well, mortgage bonds, for all intents and purposes, are U.S. government guaranteed. Mm-hmm. Fannie and Freddie are not guaranteed per se. Ginnie Mae are. I can assure you, Fannie Mae will never go bankrupt. If it was to go bankrupt, my advice then is to go buy cans of tuna, a gun, and small denomination gold coins, because it will be the end of civilization.
Okay.
So Fannie Mae is not going bust. You could buy these mortgage bonds yielding about 5.5% right now, which I could help you go and do, which is about 1.5% over treasuries. Corporate bonds that can default are only 57 basis points over treasuries. And this is kind of crazy town where you could buy full faith and credit of the U.S. government almost 1% higher than a corporate bond that can default. And if you are a believer in a hard landing, will default.
Right, but the risk with the MBS, like the normal MBS that you would see in the index, not the stuff that's trading really close to par that you're picking out, is prepayment risk, right? That's what you're trying to avoid.
So I think the better question is, excuse me, why are these mortgage bonds trading 1% higher than corporate bonds when clearly there are smart people in the world? The reason why is a mortgage bond looks and barks like a covered call, like you're selling this big call option on a 10-year treasury. And with the move at 120, that's the way you basically do a covered call. This is the way you go and take convexity risk as opposed to credit risk. These par mortgage bonds can be prepaid. Therefore, a bond trading at 99, maybe it can go to 102, 103, 104 before it gets called. That's what you're giving up when you buy a mortgage bond, is you're giving away the big upside. So if rates go from 4 to 2, a par mortgage bond, not going to be so good. I mean, you'll make money. You'll just make a lot less. And if rates go up, these bonds will go down like a 7-year treasury.
You mentioned credit risk just then. At this point in the economic cycle, how worried are you about credit risk? Given that, going into 2023, there were a lot of recession fears. There were a lot of credit experts that explicitly said they thought that defaults were going to pick up substantially. Things were going to start to fall apart in the credit market. And instead, November, December, we saw a pretty big rally in the space leading to very low spreads, which you've already pointed out are kind of in crazy town territory, at least compared to some other possible investments. So how worried are you about things like defaults in 2024?
Defaults in 2024, not going to happen. Next year, they might, when we have to refinance all the debt that was taken out. This is called the maturity wall. And there's plenty of graphs and charts about this.
On this podcast, you have to say looming maturity wall. That's the rule.
Okay, looming. Yes. Well, it's looming, but it's coming. So I'm more interested in inflation than in default, than in hard landing ideas. And the reason why is I think that the demographic of these boomers retiring with a lot more money than their parents had, which means they're going to keep on spending. The old rule was when you got older and you retired, your spending was reduced because you had lower income. The boomers, well, we took all the money, okay? I'm sorry.
At least you're honest about it. I appreciate that.
We took all the money with the stocks, with the bonds, with the housing, with everything else. And so we're going to keep on spending, but we're not going to work anymore. So we're pulling out the supply of labor, right? The millennials, they're working and they're getting married and they're having kids. So they have this demand. They're going to buy stuff as they form households. And that's what I think is going to keep inflation pressures up. The same way we had inflation in the 70s as the boomers, right, matured, formed households, bought cars. So I'm a believer that inflation, the 2% target is not coming anytime soon. There's a good story why it might. I'm just not a believer in that. And I also think that the Fed is not going to take rates down nearly as much as the market is implying by the futures market. And I think that Jay Powell, good guy, bad guy, I don't know. What I know is this. He has a lot of money. He's a nice family, nice kids, probably a nice house also. What does he care about? What do we think about? What is humanity all about? We still read the Greek tragedies. We still read Shakespeare. What do these guys all talk about that's still so interesting 3,000 years later? Hubris, ego. That's what drives humanity. It's always the fall of humanity. And I think what Jay Powell's thinking about now is really not inflation per se, but what's my tombstone going to say?
Yeah, legacy is a nicer way of saying ego.
Is it going to be Arthur Burns, who basically we all is the poster child for inflation getting out of hand? Or is it going to be Paul Volcker, the saint who saved us from inflation? Some people will say that it wasn't him, it was demographics, but whatever. He wants to be Volcker, not Burns. And therefore, he's going to go and I think hold rates up longer than people might think to go and ensure inflation is truly wooden stake in the heart dead.
So, I mean, I definitely want to get more into the sort of, I don't know, maybe psychological approach to forecasting the Fed. Maybe we spend the rest of the show on that. But I do want to go back and talk the sort of boring stuff about the mechanics of mortgages real quickly. On spreads, so the spread between the 30-year, I just did like a subtraction function, the most crude thing, but, a 30-year mortgage minus 30-year treasury. A few years ago, that spread was, I don't know, like around 1%. It got as high, got around 3.25. It's come down a bit, 2.8. So just why are spreads as high as they are? How would you describe that gap between mortgage spreads and treasuries right now? Why is it still at such historic highs?
Okay, you're supposed to use the par mortgage rate on Bloomberg MTGE FNCL. Use that.
Okay.
Versus the 10-year swap rate or the 10-year treasury rate.
It's not going to be much different, right?
You'll see about a 70 basis point spread historically back, 30, 40 years.
Okay.
It's now at 150. Why is it there? Two reasons. The easy one is vol is high. The move's at 120. That's the easy one. The harder one is that the curve's inverted. That's going to require a lot more explanation that you can go look at my commentary on my website to go read about. But those two things, the inverted yield curve and high volatility. And you're going to see when this curve steepens out, which means the 2-year rate comes down below the 10-year rate, you're going to see mortgage bonds in general go up. You'll see mortgage yields come down. You'll see the retail mortgage rate come down. So that's coming. Not yet, but that's coming.
Wait, but one of the questions about the recent dynamic in mortgage rates is it has fallen quite quickly, even though the spread between mortgages and treasuries is quite wide. I think that's the question. Like, why is it? It moved up really quickly in 2022, 2023, shot above 7%, and then eventually 8%. But now it seems to be falling really quickly, even though a lot of people thought there were structural changes in the market that meant rates were not going to be able to come down that fast.
Look, as I said, the mortgage bond market is the second biggest market after treasuries. That spread of 150 drives the retail rate. And the retail rate is going to be, let's say, another 0.75 to 1% over that rate. It's a business, and it's a competitive business, and it kind of grinds along. And so as you see the mortgage bonds tighten, have a smaller spread to treasuries, you will see the retail mortgage rate come down. You're also going to see the spread between the retail rate, the rate the homeowners take, versus the mortgage bond rate. That's going to compress in also for a variety of market reasons.
This might be a slightly unfair question, but do you have an estimate for how far the mortgage rate could come down?
Oh, yeah. I mean, eventually the Fed will cut rates. And you can see easily another 100 basis points in mortgage rates coming.
I wanted to ask you about something else that you sort of threw in there, the inverted yield curve. And this has been a massive topic of conversation for the past couple of years. I mean, even before the pandemic, the yield curve was inverted. And so the joke was that the Treasury market predicted COVID-19 and things like that. But when you look at the yield curve now, It's been inverted for a while. There's this big discussion over whether or not it is still valid as a recessionary indicator. What economic information, if any, are you getting out of the inverted yield curve? What is it telling you?
If you go look at various derivatives, it indicates right now the Fed's going to cut rates, 4, 5, 6 times. So call it 125 basis points of cutting in the next year, which seems kind of crazy unless we have a market crash. I think what's happening is this. I don't think it's the market predicting that rates are going to come down by 125 basis points. I don't think that's it. I think what's happening here is like an 85% chance that rates don't move and a 15% chance that rates go to 1%, that we have some kind of disaster. It's a bimodal. And if you add those two things together, that's how you get the down 125. No one's saying 125. I think it's 0 and 400. And people are using the 2-year rate or the 5-year rate as an insurance policy against a bad thing happening. If you think of it in those terms, it kind of makes sense because we only quote one number, but how do we get that number?
Right. So the idea is if you're long risk assets, which most people are most of the time, one way to hedge that would be to sort of, make big bets on rates coming down sharply. It doesn't mean that that's your main view. It just means that if your bullish view is going to go wrong, a way to hedge that is to, place big bets on rates.
Yeah, well, that's why the curve's inverted. But I think buying 10-year rates is kind of silly right now. If you're going to go and buy this theoretical insurance policy of the Fed doing a massive cut because of a hard landing, you want to buy the 2-year rate.
Okay.
And that's why we created another product that's basically a 5 times levered 2-year.
Oh, wow.
That way you get the duration of the 10-year.
What's the ticker on that? I want to look it up.
TUA.
TUA. Okay.
So it's a very, in theory, civilians could do it. They could just buy their own futures contracts, but civilians usually don't have futures contracts accounts. So we offer it for them for a very small fee.
Got it.
Oh, TUA. I think I remember this one. I used it to compare the performance of the Treasury market to Bitcoin.
Now I want to go look that up. Let's go back to your outlook for the year. So I really do love this sort of thinking. It's like, okay, on his epitaph, on his obituary, Powell may have this sort of like human impulse to not be Arthur Burns 2.0. But, there also is the chance for not to just avoid being Arthur Burns, but to deliver the soft landing that every economist has said impossible. So not just avoiding being one of history's sort of scapegoats, but actually being a legend and being the central banker who fought the crisis in 2020 and then delivered the soft landing when everyone said it was impossible and that we'd have to have employment go to 6% in order to get inflation down. Like, do you put any weight on this possibility that the sort of FOMC goes for the let's be legends outcome?
Oh, sure. I think they're going to try and do it. And it may well work. I'm just saying it's not going to be 6 cuts. It'll be 2 or 3. And it's not going to happen in March. It'll happen in July. That's all I'm saying.
So not radically different. Your sort of view of what the Fed does in 2024 is not radically different than what a lot of pundits are thinking.
Circling back to the duration credit convexity idea. Duration is I buy it here, it ends up there. Credit, I buy it here, it ends up there. It doesn't matter how it gets to the final destination. Convexity is path dependent. It matters how you get there. Mm-hmm. And so what we're arguing about now is not where we're going to be, but how we get there. And I'm saying that we're going to get there much slower than the market thinks, and I want to go and invest accordingly. And if I do that, this is where mortgage bonds come in. I'll say, if you want the big prediction, here it is. The Fed wants a 2% inflation rate. They'll get it eventually, I presume. They're going to put the funds rate at 2.5, 50 over for a 50 basis point real return. Historically, like if you're a bond geezer like I am, funds rate to 2 years, 50 basis points. So now we're at 3. 2's 10s, 100 basis points. So now we're at 4. So we're kind of looking at the 10-year right now is what, 380, 390, 4, whatever it is. It's done. You stick a fork in it, man. The 10s aren't moving. And I think the 30-year rate probably goes up from here as the curve re-steepens again. All the action's the front end. That's where all the action's going to be and when it happens. And so the trade that the geeky quants, the complex people, as you might say, are yelling about right now is how do I go and bet on a yield curve steepening? That's very tricky to do. Fortunately, I do have products that will do that also.
Wait, don't you just do a steepener trade? Like, what are you recommending here?
Oh, sure. A steepener is exactly what you do, but who can do that? I can assure you, people on this podcast can't do that.
Yeah. Well, we can't do anything because we work at Bloomberg, to be clear.
If you bought my PIFX ETF, that trade actually will make a lot of money if the yield curve steepens as I've described it, which is the 10-year not moving, the 2-year coming down, the 30-year going up. That'll be a very profitable trade if that happens. And the cost of holding that trade is rather slim for a variety of reasons that don't matter.
You know, one of the other things that happened in 2023 and 2022, and one of the reasons it was so painful for a lot of investors, was bonds and stocks became positively correlated, right? Everything sold off all at once. And this was bad news for anyone who had constructed a 60-40 portfolio or who had bought bonds as a hedge for riskier assets. How are you viewing that relationship going into 2024? I think there's still an assumption that things are sort of moving together, but could we get a situation where maybe they become inversely correlated again?
If you were reading my Convexity Maven commentaries long enough to notice the colors I have there, you would notice that quite a number of years ago, I was talking about this exact notion of the correlation of stocks to bonds. And what you saw was prior to 98, 99, 2000, you saw stocks and bonds go up and down together. And for the last 20 years, they went inverse. They were hedging each other.
Yeah.
And now they're back to being positively correlated again. The driver of that has been the level of interest rates. And if you go to my website, I have a number of charts that show exactly this, that when inflation's below 2.5 and 10-year rates are below 3.5, you tend to see them work in opposite directions. When they're above that, they work in the same direction. So I think you're going to see stocks and bonds correlated until we get rates and inflation back down again.
I love that. I mean, there's like an intuition. If inflation is low, Fed is more on Fed put mode, et cetera. You sort of get this like buoyancy under equities. I want to go back to the idea of the steepener. And right now, if you just were to make a chart, a dual y-axis chart, or I guess even one, 2-year, 10-year yields, they kind of look the same. But as you point out, and as people have been discussed, you could get to this point eventually where the Fed cuts, and that is viewed as reflationary or, creates this positive impulse. And you could have the decline at the short end, and then the long end is the rates go up. When does that happen? At what point? Like, we haven't seen it yet, right? So we've had these expectations of cuts, this pricing in of short end cuts, and we've seen the long end go right down along with it as the 2-year fell. At what point does that change such that the expectation of cuts in the short term leads to higher rates at the long term?
Well, there is the expression of don't fight the Fed. And the reason is they're bigger than you are, man. They're the casino. The Fed will cut rates.
Yeah.
I'm not sure when. I think July, but they will cut rates. And as they eventually start to cut rates, the curve will steepen out. The question is, how much of this steepening will be the 2-year coming down versus a rotation of 2s down and 10s and 30s up? I tend to think it'll be a rotation for the reasons you described. When it's going to happen, it's when they cut.
So right now we have markets sort of coming down with the pricing in of cuts. But you're saying when they're actual realized cuts is when we would start to see that relationship change?
Tracy was talking about this notion of the curve predicting the economy, and it's predicted the last, 8 recessions. It's been spot on for, 40 years. Us here, always talk 2s, 10s because it's kind of fun.
Yeah.
The actual research was the 3-month rate versus the 10-year rate in treasuries, not in swaps. And the 3-month rate is the Fed rate. The market can't go and pull the 3-month down with the Fed rate up where it is. So you need the actual Fed to cut the interest rates to go and pull the 3-month versus 10-year down. And that's when it'll happen. And all that's happening right now is people are, in theory, placing these bets on when this will occur. I think they're over their skis on this, but, we'll see.
I just have a couple more questions, but one of them is slightly outside the world of fixed income. But I think given your experience in derivatives and, things where the tail is sometimes wagging the dog, maybe you have an opinion on this, but 0-day options. Is that something you've been following at all in the stock market?
I find them very interesting, and they're important to the extent of when these options are trading, there's a buyer, there's a seller. It's a closed system. The world has not gone more or less optional or convex. It's a closed system. However, the two parties may act differently. So once upon a time, when you would see huge option selling in the bond market or option trading, that might reduce volatility because the seller very often would be my ex-employer, and they would not be adjusting their portfolio. Whereas the buyers, people like me when I was a trader on Wall Street, I would be delta hedging, adjusting my portfolio. And if I'm trading against the option, but the seller isn't, that'll drive the market towards the strike at expiry. The question is now is those zero-day options, are the buyers or the sellers trading them? Are they adjusting them? And is that, I'm going to guess the retail's probably selling the options, but in GameStop, they're buying it. And so what you saw there was GameStop, they would buy the option. Citadel Susquehanna would sell the option. They were hedging, retail wasn't, and that's what drove the market to be more volatile. Right now, you probably have retail selling the options and Susquehanna retail buying it, and therefore that's reducing volatility. So you got to figure out who's the buyer, who's the seller, who's trading it, and who's not. Can we know that? I see these guys on Wall Street all the time saying, this is the net gamma of the world. Like, do I believe them? Not really. It just sells newspapers.
Can I ask you a quick question? And I'm asking you this because you mentioned a handful of tickers that your firm, Simplify Asset Management, has created, like PFIX. Are these instruments that at different times you would recommend go long or short? I mean, so you have this desk where you can convert institutional quality trading of futures and swaps, et cetera, into a retail package that one could buy even on a platform like Robinhood. When I think of asset management in general, I think of like basically managers who want to create products that will go up. But is the idea here that you want to create products that allow people to have exposure in both directions?
Some of our products are more strategic, some are more permanent. One could argue that PFIX was strategic. When it came on 2 years ago, rates were at 1-2%, and they went a lot higher, so that worked. I might add, though, although the desire to buy this product is less now because clearly we're kind of in this rate paradigm of flat to lower, I'd argue that it still makes sense to own it, maybe less of it, because you don't buy insurance because you think you're going to crash. It's because you might be wrong and you might do it. You don't buy PFIX because you're bearish on rates. You buy it because you're bullish and might be wrong. And so as an insurance policy, a very low cost insurance policy, that makes sense. MTBA, which is our mortgage product, that's more of a lifetime product. I mean, that yields 150 over the curve, but you will always have exposure in the mortgage market. If you are in fixed income, you'll have some amount of money there. You should have a lot of it now in the mortgage market. And after the curve steepens and vols come down, you should have less of it.
Yeah, the PFIX chart looks fantastic if you got in 2021 and got out sort of
October
late last
31st,
year. Yeah, but
October 31st,
it looks extremely painful if you got in just before the end of the year.
Well, we just had a huge $34 distribution.
Oh, is that what it is?
Yes,
this is my fault. I should adjust it for distribution. So I'll have to do that.
You still didn't want to get in October 31st.
No.
The line is distorted at the end by that distribution.
Yeah. Since the distribution, this product has been restructured to be very similar to what it was at its original entry point 2.5 years ago. So you
kind of have to reload.
You're supposed to reload now. It's actually a little better product now than before, although clearly, from 114 down to 40 looks challenging. But remember, $35 of that is distribution.
Yeah. I just have one more question. It is the most important question.
Are you going to steal my question
of this conversation?
Your question?
Oh yeah, Joe stole one of my questions. I don't think I am.
Okay, good.
But you can claim that I have and then show me the evidence. But this is very important. What's your favorite color? Oh, was that your question?
It was close.
So.
I'm just. Can we just?
Yeah, you could tweak it.
Can I just add to the question? So for those who have never read Harley's notes, here at Bloomberg, we have the gold line, sometimes in a white line. I sort of leave it at that. Harley's notes, let's see, I'm looking at the most recent grab bag. There's the Kidaruki line, which I had, Zabibu line, the Kahawia line.
I just like listening to Joe rattle these names off.
And these are apparently all colors. So I was like chatting with Tracy. Like, do you go down through the Pantone catalog each time to come up with new catalog? Like, what are these colors? And I guess what is your favorite? But what is all this all about?
I started writing a commentary nearly 20 years ago. You can go to ConvexityMaven.com. That's my entire inventory of commentaries. I publish every, 6 to 8 weeks. It's free. Send me an email. I'll add you to the list. I'll talk about macro concepts. I started doing colors because I hated the all the charts of Merrill Lynch were all various shades of
You had
blue.
to get out of that sort of like the strict sell side, like styled guides for each bank.
And we had just created this new charting system that allowed you to actually pick all the colors available. So I started doing that just to get attention. And then after a while, I started naming the colors. That was fun. That was pretty easy to do. And then after about 15 years, you start running out of colors. So I've started going to actually now foreign languages is the trick.
Oh, got it.
But my favorite color was when I used hemoglobin for red. I like that.
Have you considered starting your own line of paints inspired by your chart colors? Because I have to say, aspergin is a very beautiful color that I would consider for a kitchen.
Something like that someday.
All right. A new area of diversification. Harley Bassman, that was an absolute pleasure. I'm so glad we finally had you on the podcast. We wanted to have you on for a very long time, and this was the perfect time to do it. So thank you so much.
Thank you.
Joe, that was really fun. I'm glad we finally had Harley on. I'm glad we got him to explain convexity to us, given that a lot of his trade ideas for 2024 seem to be all about convexity.
Yeah, no, that was a lot of fun. And I really appreciate the balance of sort of big picture macro thinking about the sort of the reputational impulses for the Fed, the sources of inflation going forward. So these big picture macro things, and then how one goes about connecting that, or as they say in the bit, expressing that in the form of like very specific trades was really interesting to hear his thinking on that.
Yeah, and this is really what I think differentiates Harley's work from some others on Wall Street. It's the attention paid to the construction of the trade and the technicals and how exactly you're expressing a particular view. Because very often, and on this podcast included, you will have people coming on who say like sell credit or buy credit or whatever, but they don't actually go into how one can or should do that. And it makes such a huge difference to returns and investors ultimately. And to get back to the sort of zero-day option question, it can have an impact on the overall market as well, like the way these popular trades are actually constructed.
Yeah, and as you've been talking about for a long time, like really large scale portfolio managers, like it's not like stocks. Not just in even something simple about like expressing a view on rates. If you're bullish, you buy stocks, right? I mean, some people might.
Right.
But even if you have some sort of view on rates, like these big names that like Pimco's of the world, like this is what they're doing. They're coming up with different ways of expressing this that is not maybe as sort of straightforward as their peers on the equity side.
Absolutely. There is a whole hidden and wonderful world of total return swaps, index options or swaptions, lots of stuff that just doesn't get as much airtime.
Totally.
All right. Shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our guest, Harley Bassman. He's at the Convexity Maven. Also, go to his website, check out his writings, send him an email, get on his list, see all the different colors he uses for charts. Follow our producers, Carmen Rodriguez at Carmen Arman, Dashiell Bennett at Dashbot, and Kel Brooks at Kel Brooks. And thank you to our producer, Moses Ondam. For more Odd Lots content, go to Bloomberg.com/oddlots, where we have a blog, transcripts of all our episodes, and a newsletter. And you can talk about this episode along with any others 24/7 in the chat room, Discord, discord.gg/oddlots.
And if you enjoy Odd Lots, if you want us to advocate for hemoglobin to be Pantone's color of the year, then please leave us a positive review on your favorite podcast platform. Thanks for listening.